All right, in this video, we're going to go over the relative strength index. The relative strength index is a momentum indicator used in technical analysis to measure the magnitude of recent price changes, to evaluate oversold and overbought conditions in the price of a stock or asset or a foreign exchange currency. Now, RSI is an oscillator like you see on the bottom of the screen, and you can use this oscillator to find different points on the market, different high and low points in the market, and use it to be confirmation to maybe other price analysis that you may do. So to really kind of go into it, what it does and how it's structured. If you look here, the 70 level is the upper part of the oscillator, which signifies overbought conditions. 30 is the lower part of the oscillator, which signifies oversold conditions. And in theory, when these conditions are overbought, oversold, it lets you know that a price change in the other direction to balance out the market is soon to happen. So if you look here, we'll use some for example. And the reason I say you want to use this with other confirmations because nothing you should just trade all by itself. But these are things that can build your story and build your bias towards a certain opportunity in the market. So if we look here, you'll see that right here was a low point in the market. So low point in the market. So basically where price had found support there. It went up. This was a downtrend. So you would more so be looking for overbought conditions in a downtrend. But this is just an example of showing you that price usually finds its level of support around oversold conditions. Even still in this downtrend, you can see this area here. Price had found support at this area and it went up. Let's look at an oversold condition. Overbought condition. Overbought condition right here. You see that price went into overbought there, and that was the overbought condition that started the downtrend. So you see overbought and oversold. You see there was resistance around that overbought position, and that could have been a potential good spot to sell. So how do you know when this is actually about to turn over? And this is a great question because when I first started, using the RSI, I would wait for price to get like in this area. I would see price in this area. And I used to automatically sell because price had touched that. But if you look at where that price was at the time, it was here. So the price was here. If I would have sold, I would have lost out on about 80 pips. So how do you know when price is really about to turn over? And there's two ways you can do it. You can do it one way by using another form of technical analysis, such as a Fibonacci extension or a Bollinger Band, or you can look for price action to actually show you that price is about to turn over. So if I see that price is in an overbought condition, I'm going to start to keep my eyes open. This merely just tells me that price is getting ready to turn over. And I'm going to keep my eyes open for a weakness in price. And what is weakness in price? A trend is when you get like an uptrend, you get higher highs and higher lows. And then on a downtrend, you get lower lows and lower highs. So I'm looking for price to stop making higher highs and slow down. So like when I get to this area here, price makes one final rally, and then it starts to consolidate. So this area here it starts to consolidate. And all I'm waiting for is either price to come back down and break the level of consolidation, or break and retest that level of consolidation. Do something like this to where you can get that downtrend. But with the RSI is going to let you know that we're getting into the upper reaches of a range. The best way to use RSI, the best way to use it, get rid of all that. The best way to use RSI is use it for divergence. And basically divergence just means that what price is doing, what price is showing you versus what price is actually doing are two different things. That's what divergence is. So if we're looking for divergence, divergence is going to give you that major indicator that price is about to turn around. So let's look for divergence. So divergence with price and the RSI is going to look like this. If price is going, like if two high points of price is doing this, the RSI should also do that. Basically to where you get something like this, where price is higher, than the next low. So this high is higher than this high. So the RSI is doing the same thing. This high is higher than this high. But when price diverges from RSI, and say we're in an uptrend with price, or not an uptrend, but you have two higher lows, but the divergence does something like this, higher highs, but the divergence creates a lower low, then that lets you know that price is diverging right now. So if this was two high points, so higher high, higher high, if this was two high points, like for example here you got two high points. If price is not diverging, you see how the RSI is going up as well. So both of them are going up. Doesn't have to go up at the same angle, but both of them have to go up. And price is not diverging. But then you see a level where maybe the price is going up or down and the RSI is doing the opposite, then that's divergence. And to show you where divergence is, we'll use this example. So you see that this is a high point here. That's a high point. And this is another high point. If price is not diverging, then the RSI is going to have this high be higher than this high. But what happens? The RSI is going up from this point. So you see that price is making a lower low on the actual price chart, but on the RSI, price is making a higher high at the same time price is making a lower low. The RSI is making a higher high at the same time price is making a lower low. So this right here is divergence. That's divergence right there. This is the best way to trade with RSI, in my opinion, when you're using it to find high points in the market. This is divergence. So I know that price is diverging, and as long as price remains lower, the actual price remains lower, then it's safe for me to continue to sell this market. So say I place a trade off of divergence, I place a trade, and the trade would invalidate itself when it goes above this high. So the high point in this market, is here. At this point, the last high at this point is there. So as long as price doesn't go above there, then my divergence trade is true. So that's where I would put my stop. And then you can continue to sell it down. Something like that. You know, other things that I would use with divergence, I would use price levels. So I see that, you know, this is a price level here. And if I go here, stretch this over, this is a price level. So if price either reaches either one of those levels, then those are areas where I can actually trade the market. You want to use some other form of confluence. And it's not always going to be a perfect markup. You see how it went above that price level a little bit, but you see the point as in this created a lower low, but this created a higher high. So you're in a good area. As soon as that happens, you're in a good area to sell. As long as your risk management is good, it should play out in your favor. Even if you lost, you wouldn't lose that much. But those are some of the things that the RSI can do. The last thing is that I want to point out is pointing out the 50 level in the RSI. Because when the market is trending, this level becomes more how can I say it, more prominent. Reason being is because you can find low points in a trending market at the 50 mark. So right now the market is trending in this area. We'll use this for example. Right now the market is trending up. Market is trending up in this area. What you can do is find, and I like to kind of zone it out, to be honest. I like to go between 40 and 50, like as a trading zone. And I'll show you why that's important. This is something that I learned from one of my mentors who's a master at trading RSI. So 40 and 50, we'll use that. So this is an uptrend. What you can do is when price reaches between this 40 and this 50, it is oversold in an uptrend. So it's a kind of a different way to look at it. But it's oversold in the uptrend. Only when price is trending. Only when price is trending. And it's oversold when you're looking for breaks and retests in the market. That's where it works best with. So price is making, to kind of illustrate where you would start to look for this, price is making lower lows and lower highs, lower lows, lower highs, lower lows. So if we're looking for an uptrend using market structure, you're just going to simply wait for when price breaks the last swing high. So if you're in a downtrend, you're waiting for price to break above the last swing high, which would be this area here, the number 4 point. So that would be the last swing high. If it breaks above there, you're looking at an uptrend according to market structure. So we extend this out. And what you would do, you would wait for price. You would either continue finding ways to sell, or if price breaks above that, then you look for a buy. So you see that price breaks above it, you wouldn't just buy right there because you're waiting for a retest. You're waiting for a retest of the last swing high to make the next swing low. And the next swing low is where you would buy. So how would you help identify that? One, you have this zone. The second you would do is you would wait for the RSI to come up, come around back into this area, the 40-50 area, because you're in you're in an uptrend. If you were in a buying trend, you would look for the 60-50 area, but we're looking at an uptrend, so doing 50-40. So you will wait for the RSI to get back in this zone. And if it gets back in this zone while hitting the retest area, then you would be open to making a buy. And this is how your trade can look out. Like if you place the buy here, so if you place the buy here, right in that area, so just line it up so you can see. And it actually gave you two chances to get to that area. So if you place the buy at either point in the market, either there or there, then you would have potentially had, if you were held it, you would have potentially had 162 pips. So 162 pips, and you could have risked, put it here. Let's say you went down to the middle of this trading range here. I always like to position my stop loss below some significant wicks. So I see here is significant wicks. That means there's buying pressure here. So I would place my trade as far as from a risk standpoint. I would have it beneath here, but beneath this wick here. Reason being because you have a zone here. These are just different things that you can look at when actually taking. You have a zone there, a smaller zone, but still a zone. And you have these wicks here. So those are two barriers in price to where you could potentially be safe at. And if you would have took that there, this could have been a 4-to-1 trade. Yep, a 4-to-1 trade. So if you're finding 4-to-1 trades, then you're pretty good. Let's look at it for a downtrend example. So price, let's look for a downtrend. Let's even look at a different pair. Here's a good downtrend right there. So this is a downtrend. So in a downtrend, I'm looking for the 50-60 area. So I got it at 50. 50 and 60. And 60. So what I got to do, if I'm looking to trade RSI in this way during a trended market, I have to wait for price to start trending down, which it does. So price starts to trend down. So you see this happening here. And then wait for price to reach the 50-60 range. So we look here, price trades down, retest there, trades down, and retest there. And the only other thing I have to do to confirm it, because you never trade solely off of RSI, you use it as a point to let you know where to look and what to look for, or when to look for something. You use one other form of confirmation. So the form of confirmation I'm going to use here is price zones. So you see that there was a price zone there. And then you could have placed your trade. Your trade would have looked something like this. Got your trade placed there. You're putting your stop loss above the last swing high, which was this point here, and you're trading to the next zone. So it would have looked something like that. And you trade to the next zone. That would have been a winning trade. And then you would simply wait for price to do it again, but also have the other confirmations. So I wanted to kind of go over a few ways you can look for price and to look for, using price with RSI and using the RSI to actually trade the markets. One last thing is that, say if you're continuing to try to find sales, you're going to be waiting for breaks and retests. So after you already made this trade here, you're going to be waiting for price to break this level before looking for another sell, because you need price to continue to show you that it's in a selling trend before getting in another trade. If you don't do that, you would have placed the trade here again. So you would have placed a trade there, and you potentially might have would have lost that trade or got out of it because this took 3 days to play out. So this is something that you can do to where you can protect yourself and know exactly where to get in and out of the markets.